Hello, YouTube. The S&P is now back above 480, which is good. And we're going to talk about the two scenarios we have this weekend. The bullish scenario goes back to a 2020 template where we went higher for as much as 50%. That is a huge, huge move. We're largely being led by tech stocks. We can see that they were on fire into the end of the week. So what we want to do this weekend is make sure we have this keyword being patience. We're going to listen to Warren Buffett because he has told us that the stock market is a device for transferring money from the impatient to the patient. We're going to go through and talk about my specific notes. Don't worry, we will come back and talk about these in a moment. We're going to talk about how fear and greed has been an excellent indicator up until here. And we're going to talk about how these short sellers are flip-flopping. They've now added back more contract short. There's also key economic data coming out, notably on Thursday and Friday, with core PCE coming out at 8:30 a.m. We now actually have a Fed pause being priced in for March. And with the Fed meeting later this month, that will be particularly important. So now we're going to go through those two options we have. The first option is what we have here with the Dow Jones. The Dow Jones last month made a new all-time high, and on the first attempt, it went to a new all-time high. If that's what's going to happen on the S&P, that is the scenario we just went through. So again, to take that all back, it means that we're just looking for higher lows and higher highs. It is so simple, and that's what I want to focus on this weekend is a simple story. So option one is that we continue to form higher lows and we continue to form higher highs. If scenario two happens, we're likely going to be tracking SMH, which we just told you has been El Fuego so far this year. And NVIDIA is up by 20% just in January. It's incredible. But we didn't just do what the Dow did. We hit an all-time high, we backed off, and then we went to a higher high. So what this really means is that it might be 6 months if this scenario plays out. What would that look like? Well, let's look at an extreme example here. This is Bitcoin. Look at failed breakout number 1, 2, and what we currently have right now. The riskiest asset is currently selling off. And the last times this happened, it wasn't pretty. It went down a lot. I'm talking 50+%. So is this time going to be the same thing for the S&P? We've not seen a monthly failed breakout. We do have one here, but I'm not really calling that a correction. 2020 was a correction, second correction, third correction, fourth, and fifth. The key characteristic here is that we formed the breakout, but then we also have to print a lower low and close below the low. So this one here didn't really play out. Our bear market starting 100%. We got that big warning. And this was the SVB crisis right here. So what that would basically look like is exactly what it shows here. A failed breakout, just like on Bitcoin. That would be scenario number 2. And I'm not sure which one's more likely. I have my assumptions. I will go through those a little bit later. But I'm going to ask you for a huge favor, if you don't mind. If you could please consider smashing that thumbs up and subscribing to the channel. That would just be so appreciated. And I'll thank you guys ahead of time because you guys have just been such a great audience. Thank you so much. I have a couple of videos I want to go through this weekend too, so please just bear with me. I'm trying something a little bit different this week. So here we have the template for, we went through the DAX. We also have SMH. So chips lead tech, tech lead SPY. That's the saying. While Germany did the all-time high back test and then went lower 6 months after it got it, so did technology or XLK. And we have to just make sure we pay attention to those two patterns because right now the S&P is currently what's driving the market higher. And TSMC, which reported earnings this week, was the key driver of that, where they had a bullish outlook for 2024. But the most expensive companies in the world are what's driving the market. So we can see PE expansion, which is what's currently happening. At a certain point, there's going to be a law of diminishing returns, though. On the flip side, a lot of concerns this week are going to come from geopolitics, which means out of the top 5, we've got 4, which are geographic or political, or again, geopolitics. So this doesn't look all that great. So at a high level, that's what we're looking for. And please keep this quote in mind as we now go through. So I'm hoping to keep this video nice and short because I'm not going to be back until Wednesday, but I want to leave you with a very simple message. So last weekend, we talked about how 480 is the only number that matters. I'll now walk you through both scenarios where scenario 1 is that we keep forming higher lows, we keep forming higher highs, and scenario 2 is that we don't. So let's just have the patience to see this monthly candle close out and keep in mind that there's likely going to be a lot more noise this week. Why? Well, we have these articles we'll look at in a moment. We got the UAE, we got TSMC, we got Jamie Dimon, we got Larry Summers, we got Mary Daly, we got economic data like PCE and GDP, and we got earnings like Netflix and Tesla. So what do? It is best to focus on levels into the end of January. Do we close over the previous high? or do we pull a Bitcoin? So we're now over 480. Do we hold it? Notably on weekly candle closes, because we've now had one weekly candle close over and one below. So notably here on the SPY, what we noticed that to start the year off, we had a weekly candle close here at 467, which is below 470, and now we have a close above 480. So both teams have scored a touchdown. Easiest way to think about it. The question is, who's going to hold it? Who's going to continue to score? This will be very important for us, because if we think about the monthly higher low pattern we're just talking about, well, if 466 is the January low, then the closer we close to that area into February, the easier it is for us to break the chart lower. So I think I have an updated note on that one there. I'll go back to my notes in a moment. And I'll actually go through these at the very end of the show, because I want to actually play a couple of videos this week. So please bear with me. The show is not going to be very much longer. I have 3 minutes of videos from very notable speakers I want you to listen to. But just remember, there's lots of noise out there. So we'll look at the levels at the very end. Couple of really quick news articles here. We got TSMC drives a $165 billion chip rally in 2024. So again, chips lead tech, tech lead SPY. Samsung was a big fizzle with their AI phone, but TSMC came out and they delivered. UAE warns time is running out to avoid a wider conflict. Okay, well, there's something good, there's something bad. What's the net effect? Well, we've talked about this too, where currently we got SMH now pulling into number one, currently up by 7.04% on the year. Volatility fell down to number two, only up by 6.99%. This one really gets me concerned here. This 10-year note at 6.73%. I don't know how the hell this is happening, to be honest. Why? Well, because we got QQQ up by 2.85%, and we got the dollar up next by 1.83%. And the loser, which finally just made a new all-time high, is the S&P. So chips lead tech, tech lead SPY, but these indicators, which I'm checking off right now, are supposed to be inverse. They're not supposed to all be green. So volatility up by 7%. Well, volatility is doing as well as chips. So the bears are buying insurance, or the bulls are buying insurance. The 10-year note, which is supposed to be inversely correlated to tech, I don't understand what's happening here. This tells me that inflation's coming back, and the fact that the dollar's up means that the economy is strong, but then also the stock market's strong. So it just means the US is the best game in town. So to wrap it all together with a nice little bow, we got the S&P here with a green light on the annual level, because we're back above that 480, which I said was good, and below 470 is bad. Very easy numbers for us to think about. On the monthly level, we're looking for 454 and 480. We're currently above 480. We are bullish. For QQQ, it's just a matter of 410. So above or below 410. And like I mentioned at the very end of the show, after we watch 3 minutes of clips, we'll read through my notes specifically. You got the key dates, I got the S&P update, and I got the QQQ update. All right, let's go through and listen to a couple of quick videos.
I think it's a mistake to assume that everything's hunky-dory. And, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, But remember, we've had so much fiscal and monetary stimulation. So I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25. And we mentioned Ukraine, the terrorist activity in Israel, the Red Sea, quantitative tightening, which I still question if we understand exactly how that works. I don't think we do. How QE actually worked, what the effect of negative, zero rates was for all this time. And obviously the politics, and and then the Ukrainian war is affecting oil, gas, food, migration. So you have all these very powerful forces that are going to be affecting us in 24 and 25. So if I was the government, I would be preparing for what I'm going to do about that, assuming things aren't good. And I just also want to point out, I wish the Democrats would think a little.
Okay, so that's the most powerful banker in the world for a private bank, again, excluding Federal Reserve. But what he's basically telling me is that buy some insurance. The U.S. is going to have an issue with debt, which is what I heard. And then also that the U.S. is still the best game in town. So what he said really resonated with me. Let's go move on to the next one.
If you were the architect once again of U.S. fiscal policy over the longer term, where should we be heading?
Let's start with the recognition that our fiscal problems are much more serious than they were in 1991 or 1993. Then we had budget debts relative to GDP in the 30% range, with out-year deficits perhaps in the 5% range on honest forecasts. Today we have a debt-to-GDP ratio above 100%, with out-year debts in the 10% of GDP range. So we've got a much more serious problem, number one. Number two, then we were reaping a Cold War dividend from the end of the Cold War, and we could reasonably expect defense spending as a share of GDP to be falling. Today, though it's not reflected in the CBO forecast, almost certainly we are going to have to substantially increase defense spending and spend.
So what Larry Summers is talking about is something that I've been concerned about for a while, which is the state of the U.S. national debt. I've been focusing on these numbers down here. He said 1990, we got 1980, 2000, and 2020s, which is where we are now. The ratio was getting very high. And what he also mentioned was the defense spending, which is now very high. Interest payments are going to start becoming even worse. So that's what I heard him say. The second thing I heard him say was that there's risk of geopolitical tension. That's what I heard him say. The current wars that are underway are not going to give us those same tailwinds we had from before. So uphill challenge when 4 out of 5 top risks for next year are going to be geopolitical, and we're indebted by 3 times more. That kind of seems like a problem. Let's see what the Fed has to say this week. Keep in mind, this next speaker is going to be a massive dove.
The economy is in a really good place. If you saw the sentiment numbers, the confidence numbers this week that come from the various surveys, people feel better. There was last month a vibe session. That was the last thing I was hearing about. Kyla Scanlon taught me this. She's an influencer, a journalistic person who does a lot of TikTok and things, and she tells me, oh, it's a vibe session. People feel bad, the data are good, it's a bad vibe. And that was 6 months ago, and I think, okay, I'm listening. But now I'm seeing sentiment data and confidence data be better. When I had a business roundtable here in San Diego this morning, what did I hear? Cautious optimism. I'm seeing an economy that is responding to monetary policy and coming into balance, and inflation coming down, but not falling off the cliff and making a worrisome situation, and that's good. The second thing that I feel is in a good place is policy. Policy's in a good place. We got policy rate adjusted so it can do its work. We see that it is having an influence. And so now we're in a great place in the following situation. We know that policy's in a good place, the economy's in a good place, and we can start to be more patient to see what we need as a Fed to do next.
So she's a dove, which means she would be one of the people who would say cut interest rates instantly first. So currently, when the Fed's going to meet a little bit later this month, they're set to meet on January 30th and 31st. The 31st is when we're going to have that press conference. As of right now, there's a 98% chance they're going to keep rates between 525 and 550, which basically means a pause. If we look forward to March, though, the odds have actually now flipped to 52. So for me, what that means is that the 10-year note being green tells me that, hey, well, something's got to give. Either we're going to fight the Fed short or long term. That's the way that I'm reading it. That might confuse you, but what this really means is that different speakers are telling us that something's going to give. It's either going to be that these things are going to start backing off and we're going to see less need for insurance, and rates are going to come down, and that the dollar is going to finally start, again, softening if Fed policy softens, or we're going into a new bull market, and these things are going to be dragging us higher. So I hope that new segment was valuable to you. And now what I want to finish off with here is just by talking about, do we actually want the Fed to cut? The answer is no. And that's because most declines in a bear market actually happen after the Fed cuts. So what's really tricky is that everyone wants the cut, but I suspect that when it finally happens, we're not going to be happy with the reason why that happens. So there's the saying is that the Fed will cut because they can, or they'll cut because they need to. If they cut because they can, that would be fantastic. If they cut because they need to, well, the Fed pivot has been terrible. So the bears have been predicting it for a very long time. But anyways, what that basically means is that we want to have a pause, right? So we can pause for like 6 months up to a year while we pause for the first time here in August. So if we were to repeat by up to 12 months, that would be August of 2024. So what that basically means is make sure you have the patience to see these candles play out. It's the monthly pattern. I showed you Bitcoin. I showed you the Dow. I showed you the NASDAQ. I showed you chips. Now let's read these simple notes, and then we're going to leave it there. So let's actually open up a new image and look a little bit closer to see exactly what these mean. So this week, I've identified the key dates. We've talked about them as well. It's light until Tuesday. After the bell, we got Netflix earnings. I will be back pre-market on Wednesday to take you through the market that day. Bank of Canada rate decision, not really going to move the needle, I don't think, but Canada's been seeing an increase in inflation. I'll be interested in their outlook. And again, what we're looking for here for March versus June from the Fed is not whether or not we actually see the pause. On the 31st, I want to hear whether or not Jerome thinks the data supports his move. I'm not sure it will. Core PCE is supposed to come in hot on Friday. Anyways, moving forward. So Tesla reports after the bell on Wednesday. And then on Thursday, we got the ECB rate decision. We got GDP out of the US. We got jobless claims. And then on Friday, the most important data point comes out at 8:30. That's going to be core PCE. If we now look to the notes again, something a little bit different where we're looking at notes instead of looking at the chart. But that's intentional. I'm doing that on purpose because you might get really confused. I think if you're watching this, you understand how to drive. So again, green light, good. Yellow light, bad. Right? Warning, sorry. Red light, bad. Green is good. Yellow's a warning. Red is bad. There's no red on here. So what does that mean? Green. Pedal to the metal on the annual and monthly levels being over 480. S&P remains overbought, but the market can remain irrational longer than we can remain solvent. Have patience to wait for a monthly lower low, which means the Warren Buffett quote, if 466 is the January low, then we ratchet up the support level to that has to hold into February, which means if in February we go below 466, hey, we're probably going lower like we saw with that Bitcoin pattern. Please note, a weekly higher low would also be over 470 this week, which is the number that we consider to be bad. If we remain over 480, bullish, simple, and easy. If we fall below, we'll enter a warning or a yellow light. That's like pretty easy. All right, so green over 480, warning below, and red below 470. Easy. Okay. QQQ, same thing. Green light, annual and monthly. Netflix and Tesla both report earnings this week. If we remain in a weekly higher low, the expansion continues. The bulls are in control. We're in blue sky territory. If we print a weekly lower low, we are also back in a yellow light. If we remain over 410, just like over 480, bullish and easy. If we fall below, we'll be entering a yellow light. That is it. That is all for this weekend video. If you want to go back and watch my preview for 2024, that's now queued up here on the left-hand side. If not, come hang out with us on Wednesday morning by subscribing on the right-hand side. Thank you so much for tuning in.